So hello guys, welcome back to my YouTube channel. It's CalFX here. So in today's trade, we're going to talk about how to catch insane risk to reward ratio trades using smart money concepts, right? So before any further ado, I gotta do the YouTube stuff. I'm not a financial advisor. Any topic discussed here is based upon my own experience and my deep understanding of smart money concepts, all right? So all right, let's get into the video. In today's video, we're going to talk about a trade that we actually called on the private mentorship. We can clearly see here. We're going to talk about this trade that we called, and one of my students actually called this trade right here. He actually closed the trade at 20 RR. He could have held, for much longer. But pretty much in this video, I'm just going to break down how we actually went about this trade. What was our confluence, right? What was our understanding about of this trade from a higher time frame perspective, all the way to the lower time frame, right? So to start, we can clearly look at EUR-USD. Let me just pull up the Vantage source right here. We can look at EUR-USD from a yearly time frame perspective, and we can clearly see something interesting. Is that EUR-USD has been bullish from a yearly time frame, right? From a long-term perspective, we can clearly see that EUR-USD has been bullish. We can clearly see that we actually had a higher high right here, higher low. Price actually broke structure to the upside. We had a successful retrace, then price actually broke structure again. So we can clearly see this bullish order flow still intact from the yearly time frame. We can clearly see here that price actually, institutions had to sell, right? We have this bullish order block right here, which means that this was the last down candle before the up move that went on to violate previous high. And we can clearly see that we had this structural low sitting right here. Pretty much this was liquidity being built. So institutions, they had to sell and then they had to buy immediately to the upside, right? So now we're seeing that price has to come back to mitigate their positions, this sell position right here that they actually opened to take the previous low. And we know that banks and institutions, they don't use stop losses. They actually leave the position open, because actually using a stop loss and after they buy, that means that they are accepting this loss right here. So they leave this sell position open, right, after they buy, and then they have to come down to mitigate their positions and then carry on the move to the upside. Now, in which situation will institutions actually close their positions and break even? For example, if we have this zone right here, we can clearly see that this actually was a zone of traffic, right? So the sell order actually we can clearly see that we have this strong push to the downside, this momentum in the candle. We as smart money concept traders, we don't have enough money. We as retail traders, we don't have enough money to cause this huge volume right here. So we can clearly see that institutions were present at this sell right here to take out this previous low, and then they had to push to the upside. Now they're coming back to mitigate their sell position. So if institutions decided to close this sell position and break even, they would have just reacted to this zone right here like they did here, and then continued to move to the upside. So them actually coming all the way to this bullish order block pretty much means that they actually get to close this sell position at a little bit of profit before they carry on the move to the upside, right? So that's a very general understanding about order blocks and pretty much the bias that institutions have from a high time frame perspective. So pretty much our outlook is just to see price actually reacting at this POI and then push price to the upside. So we can go down to the daily time frame now. Let me just use the bar replay here, because that's where I'm gonna break down. So we can clearly see that from the daily time frame, price has been heavily bearish, right? We can clearly see the price has this succession of lower highs and lower lows. Pretty much what means that means that the highs are being protected, but the lows are being liquidated. We can clearly see this bearish order flow right here still being intact. Now we had actually this POI right here. We can clearly see this is the daily. Price reacted at the bottom of this range. I actually had a refined POI right here on the 4-hour, but sometimes price doesn't come all the way to 50% of the POI. Sometimes you can just react to the bottom of the range and then drop to the downside. So soon price actually, we had this daily POI. Let me just mark it this one right here. So this right here was our daily POI. So we had this daily POI and we were looking to sell, right? So what we did actually is, because for the fact that this is a daily POI, we can go down to the 1 minute time frame. It's very low probability to go there because the range of the POI is huge. So price will still have a lot of room to breathe. So it's not advisable to go straight to 1 minute. I would recommend actually waiting for a 15-minute change of character or 1 hour change of character. So what we did is we went down to 1 hour time frame. And pretty much what we saw was something interesting, right? We had this actually mitigation right here. This was the first reaction at daily POI. Then we had price actually making this low right here. So we had the high and the low, and then we have this bullish reluctancy. Pretty much it's a high reluctancy. It's price actually failing to give a high. So what it means is that this low right here failed to take out the previous high to continue that bullish trend. And now this low right here is weak, right? So this now becomes an unprotected low that is going to be liquidated. That's why we actually saw price liquidating this low. Now, the way our students, we actually looked at this bullish reluctancy and we went down to lower time frame so we can actually find an entry right here, right? So what we did is, let me just use the replay tool. So we went down, we actually looked at this zone where price actually rejected. So we can clearly see we had this wick right here. So what this wick means, we can clearly see that this wick is higher than the previous week. So that this is a liquidity wick. It's a lower time frame order block right here. So that means that institutions had to buy to take the liquidity sitting at the previous candle. And then they had to sell immediately. And now they're coming back to mitigate that position and drop to the downside, right? Actually grabbing this previous low. So what we did is we went down to 15-minute time frame. And pretty much on the 15-minute time frame, we were waiting for that structure shift, right? We waited for the change of character, some sort of a mitigation, and then a second break of structure, pretty much just to confirm that bearish order flow on a lower time frame, because we know that from the daily price actually is bearish, right? So we want to pretty much align the lower time frame with the higher time frame. So we actually went down to the 15-minute. We can clearly see that we have we have this high, we have this low, then price made this high right here. And then we had this break of this previous low. So pretty much the first break of structure, some people call it chalk, and that's totally fine, that's correct. So what chalk means pretty much is the first sign of bearish intentions. So this chalk to the downside meant the first sign of bearish intention. The bearish order flow yet is not confirmed with the first break of structure. So what we need to see is price actually failing to create a higher high and then create a second break of structure. And that's when the bearish order flow has been established. So right here, we had our break of structure. Let's just put a break boss, right? Then we had our second break of structure right here. So we had the break of structure right here. And so my student actually had an entry right here at this liquidity wick right here. We can clearly see that we have this up candle before the down move, right? This up candle, the last up candle before the down move that went on to take out this previous 15-minute low. So we can clearly see exactly the same thing we saw the 1 hour, right? We have this wick actually being higher than the previous week. So this means that actually institutions, they had to buy to grab the liquidity sitting at this previous high right here. And then they have to come back to mitigate the POI, pretty much the RTO, return to order block, right? So they have to close that buy position that they used to liquidate this previous candle's high and then carry on the move to the downside. So we actually had marked this POI right here. This is a 15-minute POI. That's a liquidity wick. So my student actually had a limit order right here at this entry, right? So that was about 6 pip stop loss, yes. And the target was the target was supposed to be the daily previous low, right? But he actually only held to 1 to 20. But in this particular video, I want to show you how you could have caught the same trade. This actually, you could have had a really, really nice trade right here, just using 6 pip stop loss. But let's go on the lower time frame, such as 2 minutes, to see how you could have reduced your stop loss for a better risk to reward ratio, right? So inside the 15-minute POI mitigation, what do we see? We can clearly see that we have the structure. We can clearly see the price actually had this high, higher low, higher high, higher low, then price made this higher high. We can clearly see the reaction at this bullish order block that was responsible for taking this previous high. So we have the reaction. We have a failure of price actually keeping this bullish order flow. So we have that bullish reluctancy, high reluctancy. So we have the break of structure right here. We have a successful retrace. Then we have the second break of structure. So pretty much with the second break of structure, that's when the order flow transition has been confirmed, right? So we have exchanged the hands from the bullish to bearish after the second break of structure. So let me just mark it right here. So this right here was the low that was violated. So we have a break of structure right here. Then we had the second break of structure right here, right? So we can see that the first POI, it would have been this one right here. We can clearly see that we have the last up candle before the down move, but price actually ended up reacting to maybe a inside bar on the lower time frame. But then we had the second break of structure. This actually was very clean and had a huge momentum right here. We can clearly see the institution's involvement at this particular time. So this right here, this last up candle before the down move that went on to break previous low, this would have been our entry. So you could have set a limit order right here. And you could have gone for a 2 pip stop loss, right? So this would have been very, very, very good. We can clearly see the entry from the 15-minute was very, very valid, and you could have used the 6 pip stop loss, but from the 1 minute, you could have used just a 2 pip stop loss, pretty much dramatically increasing your risk to reward ratio. Now, let's go to the target, right? We can use let's go to 1 hour time frame. From a higher time frame perspective, we know that the daily, pretty much the daily has been bearish, right? So if daily is bearish, we're expecting the price to take out this previous daily low, right? So this right here would have been your long-term target. So this low right here, we can clearly see this one. So this would have been a 1 to 182 risk to reward ratio, right? So, I mean, this is crazy. So let's just go to the 4 hour. So if you had your limit order right there, you could just play the replay. So you can clearly see that our bias from the higher time frame was very correct. We can clearly see that price actually took out the daily previous low. So pretty much the whole higher time frame and lower time frame confluence was very present. We were able to pretty much correlate the higher time frame with the lower time frame, because I think that's one of the things that is very important in order for your trades to be high probability. We need to have a confluence on the lower time frame with the higher time frame. So pretty much that's what we did right here. The daily was bearish. We went to a lower time frame inside the daily POI mitigation. We looked for that 15-minute structure shift, which was the 2 breaks of structure. And then inside the 15-minute POI, we looked for the 2 minutes 2 breaks of structure, right? You could have used the 1 minute as well. That's no problem. That's totally fine. But that's it, right? The higher time frame was this daily low, right? So pretty much, I'm just gonna end the video right here. If you guys like the video, make sure you guys hit the like button and subscribe for more content. I actually will post more contents in the future. So just do me that favor, hit the like button and subscribe. And I see you guys next time.